Good morning, everyone. Happy Saturday, the 31st of August. Hope you all are having a great start to your long weekend. It's JJ from Micro E Futures here. Going to do a video today, and my entire mission in teaching is to try and cut through the noise, cut through the red tape, get to really important facts that will help you make good business decisions, which are trades. So today I'm going to do a little video here, and it's going to be a bit long-winded. It's the anatomy of a sell-off, then a rebound, and why after a sell-off, why price moves so quickly to the upside. And we're going to take a look at this. I'm going to show you how this happens using a simple 15-minute chart with a volume profile. And we're going to talk through this. And I find the best way to learn is to walk through a market and understand what's going on when a market is performing a certain business operation. Now, if you understand the business operations that move price, right, you will understand in a more clear fashion when to trade, when not to trade, and also it'll keep you from looking to get short in the wrong place and get long in the wrong place, because these are really more of the simple way things that traders do is they're shorting at the bottom, they're buying the top, and they're trading at the wrong time. So let's take a look at this. It's a very simple 15-minute chart. Now you see here we have a liquidation. You know, price gets up here above 56.50 and then it liquidates down. So when it liquidates down, I'm going to take that volume profile, and if you see, check this out, folks. If I just stopped it there, you'd see all of the volume is trapped above. This is a distribution, because we sold people product up here. They bought it. They're long, and you can see how thin these markets are. There's not much buying on the way down. There's a little bit of a ledge here, a little bit of a ledge here, and then another price fall, right? A little bit. These are little areas where there's some short covering orders, okay? And then the market just keeps continuing lower and lower until it finds its bottom where the sell orders have completed. Now, if I take it to that candle, you can see that we have a cost basis. Sorry. You can see that now we have a cost basis really underneath that blue, the bottom of this blue line. So what I did is I go and I look for balance. I look for a high and a low, right? And I try and find, you know, a place where there's two-sided trade happening. Now, this is not the greatest balance zone, and this one's actually above cost basis. So I already know that this is a little bit of a distribution, right? Because traders had to take in product here, right? If I go and double this cost basis to the downside, you'll see what I'm talking about, right? You can see it's pretty close, right? And this is going to help later on. So this is a cost basis, and this is cost basis to the downside, but this is negative, right? This is the sale part. So then what we do is, okay, so the market's liquidated, and maybe we missed the short, okay? What do you do when you miss the short? Well, you got to sit and wait for the market to find its bottom. Now, that's where, as they say, patience pays, because you allow the market to do the work for you, right? Finding a bottom is an expensive proposition. It is called price discovery. And you, as a retail trader, right, the smart thing for you to do is let somebody else pick up the tab. Okay. That's when you got alligator arms, right? Like when you go to dinner with really, really wealthy friends. And it's a $5,000 dinner bill. And it's like, oh, my arms can't reach. Okay. So you let the large traders work this out. Okay. Now, once it gets above this area, it's going to take some time to clean this volume out. Okay. Down here. So now we're going to drag the volume profile. As you drag the volume profile through that blue zone, you can see that there's quite a cost basis here and here, right? So that's the cost basis of the inventory that's accumulated. Now, what we're going to do is we're going to take that inventory and we're going to sell it so we get into the green zone above cost basis. Now, watch this. Magically, you're going to see this area here, right? You're going to see this area here expand out and you're going to see distribution. So if I drag the volume profile, drag it, drag it, drag it right to there, right? Right to where it breaks, you're going to see the distribution of this product up here over time sideways, right? Now, we did a little look above and fail of whatever this level is, 56.37. So a lot of people would have tried to short this on the 15-minute, a little harder to do. If you break it down to a 5 and 1 minute, you'll be able to see that level and put a look above and fail trade together. But what happens is now we've trapped these people long. We run out of buyers. The market breaks, and as soon as it starts taking those lows here, the market comes right back into this balance zone. Now it breaks through that balance zone, and you'll notice it comes right back into that cost basis and flushes it. Now watch this. We're going to go out, 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 and as soon as we get to that candle, you can see that chunk of volume. That's the late stragglers getting out, and it's all absorbed. So the trade here is the look below of this level, and I'll just mark these levels out for you. Okay. So that's a look below 56, look, 55.97 and a quarter and fail. So you'd be buying up here once it, you can use the 1 minute candles, right? So this is your trade. It's the look below and fail. You buy the fail, the backside of the move, right? Of course, you're not going to get that candle right there, but you're going to try and get some product in this area here, right? Put a few contracts together, right? And now where are you going to get, where's your risk? Your risk is 55.97. If it breaks that, then the order flow doesn't support the trade. Now, where are you going to sell some, right? Say you're long a bit at 56.03, 510 contracts. Well, you put your sell orders out, right? And then you maybe take some off here at 56, 12 and a half, 13, right? Not a bad trade, not a bad trade. As it comes up, you take some off, right? Sorry, arrow's in the wrong spot, right there, right? That green candle. Now, what happens there is the market liquidates, okay? And there's only a limited amount of sell orders, right? It's not an infinite amount of supply. So once that supply flushes cost basis, comes back up, shorts are the first to buy. Okay, so it's shorts, then wholesale longs, then we start to come in, right? With the momentum traders, right? That's four sets of buyers now. Now the people who shorted down here in the hole, they are the fifth set of buyers. And once they realize they're in trouble, uh-oh, that's when you get those big green candles up as the market goes and searches for supply. That's a beautiful look below and fail on a 15-minute. There's your opportunity right there. So if you miss the short, if you miss the short back down, you can wait, put together a nice look below and fail trade, and then you're long and you're selling on the way up as a professional would do. Okay. So that's the trade there. Now, here's the next part of this, right? Now, why does the market take out these highs at the end of the day? Well, because now if we take out and move our volume profile, you can see when the market gets to this level here, ladies and gentlemen, the inventory is now underneath us. Okay? And these areas which you guys call high volume nodes, that's where the majority of the inventory is priced. Okay? Now, you're going to distribute up here at the end of the day like we did at the end of the day Friday. So, what are your trades going forward in Globex, right? When Globex opens, you're looking for a move back down underneath 55, 52. And if that breaks, then we can come back down and just use the levels, right? Anyway, bit of a long video, right? But I wanted to show you that the best entry sometimes is after the sell-off when you see trap shorts getting short in bad location. Now, sounds really complicated, but it's not. Once you understand the process, how inventory is marked up and then sold off, we can help you put together a nice trade, right? That's low stress, that takes advantage of the business. Instead of you fighting this thing all the time, getting stopped out, blowing up accounts, come learn from us on how to trade with the market in a lower stress environment where your risk is always, always measured. Your risk is always at the forefront because if we can keep you trading, if we can keep you from blowing up accounts, eventually you're going to learn. But if you keep blowing up your accounts, you're not going to learn because you're going to go through a horrible mental cycle of anger and all of these emotions. If we can keep your money while you're learning, teach you how to use risk management appropriately, intelligently, learn the business, learn when to trade, when not to get into the way of these large traders. If we can do that, we can really help you trade from a nice, calm place, right? And make a decent living and where you're not up at 3 o'clock in the morning babysitting trades, all of that sort of thing. The stress of the trade is lower when you're involved at the right time, right? And the right side of the move. And we will teach you that. Come check us out at microefutures.com. We've got a 7-day trial. I'm JJ. Let's make risk management sexy again. Let's keep, let's help you keep your money, earn an income. Have a wonderful weekend. Enjoy your Labor Day, and we will see you on Tuesday. Thanks, everyone. Bye for now.